Good morning, friends. So, welcome to this comprehensive revision series of CMA Final Advanced Financial Management. We are revising the chapter Portfolio Management, and in the previous lecture, we revised the basic concepts related to portfolio management. How to find risk and return of individual security, how to find risk and return of portfolio of securities. Okay, then we found out what is the relationship between correlation and covariance, and we also found out portfolio risk for a 3 security portfolio or n security portfolio. Now we will move on to the core discussions in this chapter, that is Markowitz portfolio theory. Okay, we will start with Markowitz portfolio theory. Later on we will continue discussing all the theories one by one. Okay, see, now we will try to understand what Markowitz portfolio theory says. See, this chapter is all about managing the risk as well as optimizing our return. For a given level of risk, how much return I can earn. Are you all understanding? So I should construct a portfolio in such a way that the risk is also managed and the return is maximized. Okay, this portfolio I call it as optimum portfolio, which means if investor is willing to take 20% risk, for that particular 20% risk, how much maximum return I can earn by constructing a portfolio in such a way that I can earn 25% return or 30% return, whatever is the maximum return possible. Are you all understanding? Now, okay, one by one we will try to understand. So all the concepts, all the theories talk about how to construct a optimum portfolio. So the the minimum variance portfolio we will try to discuss, okay, or optimum portfolio. This is as per Markowitz portfolio theory. Like this, okay, in Sharpe also provides a methodology for finding optimum portfolio, Sharpe optimum portfolio, right? So one by one we will try to discuss. See, this topic we will only understand through numbers. So we will take one example to understand this Markowitz portfolio theory, and through which we will understand the entire concept. Shall we see? This example I have given as question here also. If you can see, I have given in question number 8. Okay, take question number 8 for a discussion, right? Through solving this question, we will understand the crux of the theory. See, particular security A given, security B given, risk and return of security A and B is given. Standard deviation means risk and expected return. Okay, this is X bar, average return given 12% and 20%. Okay, and the correlation between these two securities given. So security A, security B, two security risk and return given, and correlation between these two securities in the market is also given as minus 0.2. Calculate the return and risk of the portfolios for different combinations of A and B, and explain with the help of the data arrived at the concept of efficient frontier and efficient portfolio. See, what we are going to do to understand this is, we are going to construct 6 different portfolios. Are you listening what I am trying to say? 6 different portfolios using security A and B with varying proportions. Assume, so if I have 100 rupees in hand, I can put 80% in security A, I can put 20% in security B, I can put 30% in security A, 70% in security B. Like this, different permutation combination possible? Yes, of course. So what I will do, I will construct 6 different portfolios using the same security, okay, having respective risk and return. Now what will happen to the portfolio risk and return, we will try to analyze. Are you listening what I am trying to say? I will, okay, invest in varying proportion, okay, these two securities, and I will see what is the impact of this in the portfolio risk and return. Shall we? Okay, thereafter I will conclude the Markowitz portfolio theory, how to find optimum portfolio. See what happens here. I am constructing 6 different portfolios, 1, 2, 3, 4, 5 and 6 different portfolio. But what is the catch now? I will construct a portfolio with varying proportions, which means if you see, in the first case, portfolio 1, okay, in the first case, entire 100 rupees or 100% invested in proportion A, okay, which means the amount invested in security A will be 100% and security B 0%. Are you listening? What in such a case, what will be my portfolio risk and return? Portfolio return is nothing but weighted average return of the individual securities inside the portfolio. Up 100% into 12 plus 0% into 0 plus whatever is the return amount. What is the return for security B? 20% into 0. Whatever is, it is 0 na. So which means ultimately it is 100% na. The portfolio, the risk will be same as security A risk. Why? Because entire amount is invested in portfolio A. Are you listening? First part, first portfolio I construct using 100% money invested in security A and 0% in security B, I get portfolio return as 12% and portfolio risk also same as 20%. Why? There is only one security inside the portfolio, the risk will remain same. Next portfolio I construct, 90% I invest in security A, 10% I invest in security B. What is the return from this portfolio? 12.8%. How do I find 90% into 12%? See here, 90% security A na, but 12% into 90% plus, okay, 10% into 20%, which means, sorry, my throat is not well today. Okay, you have to adjust. Okay, I have severe cough, no issues here. So, what is happening? Please take your calculator. Next weighted average return you need to compute now. So 90% and 10%. 90% into 12. 12 into, okay, which is 10.8% plus 2%. 12.8%. Are you all understanding? Return of the portfolio if my portfolio consists 90% of security A and 10% of security B. Come to portfolio risk. How would you find? See, in the previous portfolio risk was easy because there is no money invested in security B. You got 20%, same as risk as, okay, security A's risk. But here the problem is, okay, when you invest 10%, your portfolio risk formula changes na. Are you understanding? Square root of, okay, W1 square sigma x square plus W2 square sigma y square plus 2. These calculations you need not give. I have given already. Are you all understanding what I am trying to say? I have given you straight away the calculation so that we just focus on the conclusion here. We are revising, not an entire, okay, we are not focusing on calculation of these. I have already calculated. You can go and verify this. Okay, why I want to interpret some result, okay, and interpret the results of these various portfolios and I'm not focused on the calculation part. You can believe me, it is 17.64%. Next, to come to portfolio 3, what happens? I inject 0.75 na 75.9% in security A, 24.1% in security B, and the return of the portfolio is nothing but, okay, weighted average return of the individual security 75.9% into 12% plus 24.1% into what is that? 20%. Like this, if I compute, I get 13.93 as the weighted average return of the portfolio, wherein 75.9 is the proportion of A, 24.1 is the proportion of investment in B, and risk of the portfolio comes to 16.27. Like this, I computed for all these varying scenario. 50%, 50%. This is a portfolio return, portfolio risk. 25%, 75%. Portfolio return, portfolio risk. 0%, 1%. Okay, entire amount is invested in security Y na. The Y is return 20% will be there, and the risk of the Y will be same as portfolio risk. Are you all understanding? This you understood, the calculation and all understood. Now come to the interpretation part. What happens? You see, observe carefully. What happened? See, from this question I can understand that the security A is there na. This is a low risk, low return security. Low risk and low return security. Why? Because the standard deviation is lower. Okay, 20%, and the return is also lower at 12%. The security B is a high risk security, and high reward security or high return earning security. Are you all understanding? Security A is a low risk, low return security. Okay, security B, even though we take higher risk for purchasing security B, it gives a higher return. Are you all understanding the nature of these two securities? Now what happens? You carefully observe. In the first portfolio, okay, the entire amount was invested in security A, low risk security. Are you all listening? From there, in the second portfolio, okay, here proportion of B was 0. In the second portfolio, I slowly try to inject the high risk security into my portfolio, high risk, high return security into my portfolio from the second, okay, portfolio. Are you all understanding? So the first portfolio, entire amount was invested in low risk, low return security A. Slowly, gradually, what I do, I increase my proportion of the security B inside my portfolio. Okay, 10%, 24.1%, 50%, 75%, and total 100%. In the last case, what happens? Entire amount I invest in a high risk security. Are you listening? Now what happens? My portfolio only had security A. In that, now I increase high risk security. Upward, naturally, high return security as well as high risk security. See here what happens. How the risk and return performs, you need to carefully observe. In the first portfolio, I had a return of 12% and 20%, which was same as low risk, low return security. Security A. Portfolio risk is same as security A's risk and return. Now what happens? As soon as I inject more and more of high risk high return security, what happens? My return of the portfolio increases from 12% to 12.8%. My risk also, my risk, okay, instead of increasing, it reduced. The magic is, instead of risk increasing, the risk got reduced. Why this happened? Because of the negative correlation, because of the correlation minus 0.2 given na. Because of this negative correlation effect, even though I inject a high risk security into my portfolio, surprisingly my return increases, but my risk reduces. Diversification reduces risk. This concept I explained in the previous lecture. Now you are understanding what is the importance of that? Okay, now you see, to the contrary, what happened? Instead of the risk getting increased, it is getting decreased. This is the observation. Now, okay, I thought only by injecting 10% this happens. Let me inject more. I inject 24.1%. Why is this 75.9% and 24.1%? What is the beauty of this? Okay, this I will discuss later. Are you understanding how this proportion is being calculated? How this is called as minimum variance portfolio? I will explain later. First you understand that what happened next. 24.1% I inject into portfolio. Then what happens? Okay, my return increases. Yes, as expected. You see, the portfolio security B is having a high return. So the return increases. Okay, and risk also reduces. Risk again also reduced from 17.64. It even further reduced to 16.27%. Are you understanding? Now, by diversifying more, by injecting more and more security B, I am able to maximize the return, but even reduce the risk as well. This is what happened. Next, what happened? I get little more greedy and I inject 50% of my security, 50% of my money into security B and 50% of security A. Now what happens? The return increases. There is no surprise. Obviously, if you include high return, high risk security, return will increase. But to the contrary, what happened? The risk is also increasing. It took a U-turn till this moment. Okay, the risk was reducing from 20%, it came down to 17.64. From 17.64, it came down to 16.27. Okay, again I injected more. Okay, thinking it will even further reduce my risk. Now the portfolio risk increase instead of reduction. Again I increased 75% increase my proportion of security B. Again return increases, but risk even further increases. Then entire amount if I invest, okay, the risk will be nothing but the security B's risk, 40% risk. Are you all understanding? Now the key observation is what happens initially in the first three portfolio. As and when I keep on injecting the high risk, high return security, my return increases but my risk reduces. But beyond some point, my return keeps on increases, obviously, because high return security, if I inject, the return will increase. But the benefit of the diversification vanishes. And the risk is also getting increased beyond some point. Are you listening what I am trying to say? Okay, what the Markowitz theory says, okay, as per Markowitz portfolio theory, okay, he says that, okay, this is the optimum portfolio. This is the portfolio 3. The portfolio 3 is the optimum portfolio, which means, okay, this is the more efficient portfolio. This is from portfolio 3, 4, 5, 6. These 4 portfolios are all efficient portfolios. Very simple. See here what happens. Security A is a low return and low risk security. Security B is high return and high risk security. When portfolio has only security A, its return was 12% and risk was 20%. When we inject security B into the portfolio, logically the return and risk should increase. As expected, the return increased, but to our surprise, the risk did not increase. In fact, it has decreased. This is in case of 1, 2 and 3. Okay, this is due to the diversification benefit or the correlation effect, negative correlation effect. The risk reduction is not permanent. We saw only up to portfolio 3 the risk reduced, thereafter risk also increased. After portfolio 3, the return increases and risk also increases. This I can show it in the graph. Okay, you will have absolute clarity. This is how you plot these, okay, risk and return. See, this is the x-axis is risk and y-axis is return. Very simple. Can you see this 20%? Okay, 20 security A, the portfolio 1. This is nothing but 1, 2, 3, 4, 5, 6 portfolios you have. Now, if you carefully observe what happens in this theory, okay, 20% is the risk and return was 12%. Here 12% na? Okay, so 12% risk. This you plot. Okay, this is not I have plotted manually. This I have just typed in the Word file and I have taken a printout and added as an image. Are you understanding what I am trying to say? Because don't question this plot. It is exact perfect plotting. Okay, this is perfect plotting to make you understand the efficiency frontier, the curve I wanted to make you understand. So this is point number 1, which is security A. Okay, 100% security A, portfolio 1. Point number 1 in this is portfolio 1, 100% of security A, 0% security B. Now this is point number 2, portfolio 2. Okay, what is that? 90% security A. Are you all understanding what happens to portfolio risk? This is portfolio risk and return. This is portfolio risk and return, not individual securities risk and return. Here it was same because 100% was invested in security A. Now, when a 90% of the money invested in security A and 10% invested in security B, portfolio risk and return, I told you na, these two data have been plotted in the graph, which means 17.64% and 12.8. 17.64%, can you see somewhere around here? Okay, this 17.64% and 12.8%, the return also increased. Can you see? Okay, like this return also increased, but the third point, okay, the return increased, the risk reduced. But beyond that point, what happened? Okay, the curve began right hand side. Initially, see what happens? It increased, means it is going up. The curve is like this. Can you see? Notice this curve is like this. Okay, which means here 0.1, okay, here 0.2, and the edge of it is 0.3. Can you see? So initially what happened? It started moving leftwards. Leftwards means risk will reduce. This risk na x-axis is risk. X-axis represents risk, which means if you come leftwards, the risk is reducing, and if it goes upward, the return is increasing, which means initially what happened in the first three portfolio, the risk reduced, return also increased. It is moving leftward and upward, leftward plus upward. But beyond the point, what happened? The leftward movement, the risk reduction stops. The risk reduction stops, and the curve began moving right hand side and upwards, which means return is increasing. This is 4, this is 5, and this is 6. Okay, the return increases. So this is moving upwards, no doubt about it. Here, point 1, 2, 3, 4, 5, 6, everywhere return is moving up. Okay, but the risk, okay, left hand side, it doesn't go beyond that. It stopped and then started moving right hand side. Are you all understanding? Now we can observe that the curve first moves leftwards upwards because introducing security B reduces risk and increases return. After some time it turns and begin to move rightwards and upwards, i.e. the return increases, risk is also increases. Not only the return increase, the risk is also increasing. Are you all understanding? So what is the observation, sir? It means, see, for this given level of these security, for a portfolio having these two security, for a portfolio having these two securities, security A and B, for the given level of correlation of minus 0.20, the best portfolio you select me without increasing risk for a given level of risk. What is the maximum return? The portfolio 3 will give me maximum return. This portfolio 3 is called as optimum portfolio. This portfolio 3 is called as optimum portfolio as per the Markowitz portfolio theory. There is a formula for it and we will explain everything. Before that, first you need to understand this is called as optimum portfolio, portfolio 3, the efficient portfolio or optimum portfolio. Now, this line starting from 3 to 4, 5, 6, if you see this, I will show you. Okay, can you see this plotting? This is taken from the same image. Okay, instead of these two, here it was 1, 2 and 3, correct? This is 2, this is 3, correct? Now the 1 and 2 are inefficient portfolio, and from the third portfolio it became this curve. Can you see? This is called as efficient frontier, efficient frontier. Okay, this is called as Markowitz efficient frontier. What does it mean? Very simple. Okay, you need to understand the portfolio. Okay, you need to segregate is an efficient portfolio or inefficient portfolio. Now you will understand what you mean by efficient and inefficient portfolio. See here. Okay, I have given the notes also. Okay, see, carefully observe. Efficiency frontier. Portfolio 1 and portfolio 2 are inferior to portfolio 3 because it gives higher return for lower risk. See, a portfolio is called efficient portfolio. A portfolio is called efficient portfolio. Sir, when the portfolio is called as efficient, you are saying some portfolios are efficient and inefficient. What is this efficiency? I'll tell you. There has to be three conditions. Okay, this either of these three conditions if satisfied, okay, this portfolio will become efficient. For example, see, a portfolio is called efficient portfolio. There exists no other portfolio that gives more return for low risk. See, there are two portfolios wherein the other portfolio is giving me more return for even lower level of risk without taking, see, suppose this portfolio is giving 20% return for 10% of risk, and the other portfolio is giving, okay, 25% return for just 8% risk, which means this portfolio will be inefficient to that portfolio. Now, if there exists no other portfolio which is giving me more return for lower risk, which means obvious for this given level of risk, this is the maximum return I can earn, which means this portfolio become efficient. Are you all understanding point number one? Or point number two, this portfolio is called as efficient portfolio if no other portfolio gives me more return for same risk. So for example, A portfolio, B portfolio is there. Okay, A portfolio's risk is 10% and B portfolio's risk is, okay, I'll come back to the risk later. Return is 20%. A portfolio A's return is 20%. Now, if there do not exist any other portfolio which gives me more return for the same risk, there is B which is having 10% risk, but the return is only, okay, 18%, which means for the same 10% risk, is there any portfolio which is giving higher return? Not so. No, not giving, which means this is efficient. Are you all understanding? This is also one possibility. Then the third possibility, same return for lower risk. This is also a possibility. See, if this is A is giving me 20% return for 10% risk, assume there exists a C portfolio which is giving me 20% return, but just for 8% of risk, which means lower risk, and it is giving a same return, which means this will become inefficient. But if there exists no other portfolio which gives same return for lower risk, then also this portfolio will be efficient. Now A portfolio is efficient. This is how you will compare different portfolios. We have one beautiful question, RTP question, through which we will understand efficient portfolio and inefficient portfolio. Earlier, they don't test these areas, and recently, okay, within 1 year or so, recently they came up with an RTP question, okay, with all this efficiency frontier. Are you all listening? So anyway, anytime it can be tested in the examination. So don't think, okay, just whatever are the questions which I have already asked, they only will be getting tested in the subsequent attempt. No, not so. New questions may easily be framed from these areas. Okay, conceptually if you understood, everything will be fine. So now I will say what happened in this case. You need to understand what happens. Okay, these 6 securities I have given now. So now you see what happens. Okay, these 6 securities are there. Carefully observe what is happening. Okay, now see the portfolio 1 is there, portfolio 2, portfolio 3 is there. Now, portfolio 3 is giving me 13.93, which is a high return for lower risk than these 2 securities. Securities is portfolio. Portfolio, okay, 3 is having a risk of 16.27%, which is lower than portfolio 1 and 2 risk. Are you listening? By taking a lower risk, you can earn a return higher than portfolio 1 and 2. Hence, portfolio 3 is superior than portfolio 1 and 2. Are you listening this concept? Why? Because it is giving higher return for lower risk. Condition agreed, accepted. So 1 and 2 became inefficient to portfolio 3. Now let us verify whether portfolio 4, 5, 6 are also inefficient compared with portfolio 3, or portfolio 3 becomes inefficient compared to portfolio 4, 5 and 6. Not so. Why? Because if you notice, yes, portfolio 4, 5 and 6 are giving higher return. But for same risk, for higher risk, not for same risk. If portfolio 4, 5 and 6 had the portfolio 4, 5 and 6 given me higher return for same level of risk, okay, then this will become efficient and 3 will become inefficient. But 4, 5 and 6 giving me higher return by taking a higher risk, hence portfolio 3 will never become inefficient due to 4, 5 and 6, and 4, 5, 6 also will not become inefficient to portfolio 3, which means 3, 4, 5, 6, all these portfolios will be called as efficient portfolio, because there exists no other portfolio which gives same return for lower risk, higher return for lower risk, okay, same return for, what is that? Higher return for same level of risk. Are you all understanding what I am trying to say? Okay, now these 4 securities are called as efficient frontier. To put it simply, in this graph itself, I don't want to confuse you, but I will draw it again and show you what happens. Okay, in this graph itself, see what happens. This is the efficient portfolio, 4, 5 and 6, 4, 5, 6 and 7. Are you all understanding? Correct? Now this is 1 and 2, 1, 2, 3, any number you can take. Okay, there are n number of portfolios, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. There are, assume market you constructed 17, 18 portfolios. Now if you compare it, this is called as efficient frontier because whatever is lying in the efficient frontier will be superior, will never be inferior to any other security. Why? Because assume this is 16. Okay, this is the what do you say, the x-axis is risk na. This is risk means, assume for the same risk you can see corresponding higher point in the same efficiency frontier. If you take this portfolio 9, for the same risk there is a higher return giving portfolio compared to this portfolio. Are you listening what I am trying to say? Like this, okay, the highest point will be lying in the efficiency frontier, and below the frontier whatever might be the portfolio, I can draw like this. If this is the efficiency frontier, see carefully observe, if this is the efficiency frontier, okay, these dots are so many portfolios lying below the efficiency frontier. These are all inefficient. Why? Because assume this point is taken, for the same risk higher return there will be some point in the lying in the efficiency frontier which will be superior. Are you listening? Very very profound discussion. I don't want to confuse you further. Okay, in the regular lecture we used to discuss all these things. So one line summary of the entire discussion. Okay, I construct a portfolio in 6 different proportion. Out of this 6 different proportion, this is called as optimum portfolio. This is my optimum portfolio. Okay, even though all these securities are efficient, even though all these security 3, 4, 5, 6 are efficient, but my optimum portfolio, okay, is security 3, which portfolio 3, whereby I put 75% of money in 75.9% of money in security A and 24.1% in security B. This is called as optimum portfolio as per Markowitz. Are you listening? What is the catch? Now you will understand the crux of the discussion. See what happens. In this question, correlation given minus 0.20 between these two security. I told you little earlier in the previous lecture. Okay, if you have not gone through, please go through those lectures. Okay, first part of the portfolio management to understand the basics. Then only you can understand these things. There I have told you, if correlation is perfect negative, means -1, you can even bring portfolio risk to 0 by appropriate proportion, by investing your money in appropriate proportion. The proportion I calculated na P. Okay, x is equal to, proportion of x is equal to sigma y by sigma x plus sigma y. Proportion of y is equal to sigma x by sigma x plus sigma y. Like this, okay, we can even bring the portfolio risk to 0. You tell me children, in this question, can I reduce the portfolio risk to 0? No, zero variance portfolio I cannot construct. Whatever you try, okay, you cannot construct a portfolio in such a way that the portfolio risk will never become 0. You cannot reduce the portfolio risk to 0. Why? Correlation is not -1. Okay, if correlation is -1, you can do that. But here correlation is -0.2. For this given level of correlation, what is the maximum risk I can reduce? 16.27. This is the optimum portfolio for the given level of correlation. This is what that we saw zero variance portfolio. This is okay, minimum variance portfolio. Are you understanding the difference between these two names? Minimum variance portfolio na, for the -0.2 correlation between these two security, okay, the maximum risk reduction or the maximum standard deviation, okay, you can bring down to 16.27%. Below this you cannot reduce. For this 16.27, what is my optimum return? 13.93. Okay, yes, even though you have 16, 18, 20% return, you can earn, but not by taking just 16.49. The risk is also increasing. The risk will also increase. Are you listening? These are all the discussion. This is called as efficiency frontier. This frontier 4, 5, 6, 7 alone. Portfolio 1 and 2 inefficient, you will leave. The curve which consists of only efficient securities is called as efficiency frontier. Are you listening? Okay, notes I have given. Now, Sir, you calculated the 75.179% and 24.1%. What is the secret number? Nothing. There is a formula given for proportion whereby the correlation is not -1. This is called as minimum variance portfolio formula as per Markowitz minimum variance portfolio formula. Proportion of A is nothing but sigma B square minus sigma A sigma B correlation of A and B divided by sigma A square plus sigma B square minus 2 sigma A sigma B, okay, sigma B correlation of A and B. If you notice, okay, either minus the minus sigma A sigma B correlation of A and B. Here also sigma A sigma B correlation of A and B is there, minus 2 sigma A sigma B correlation of A and B. This formula is for finding proportion of A. Proportion of B, in this both the cases the denominator will remain same, just like in the previous discussion we solved a zero variance portfolio there also, and the numerator undergoes a change. When you find proportion of A, it's nothing but sigma B square minus sigma A sigma B correlation of A and B divided by sigma A square plus sigma B square minus 2 into sigma A sigma B correlation of correlation of A and B. The denominator will be same, numerator. Okay, when you find the proportion of A, you replace it with sigma B square. When you find proportion of B, you replace it with sigma A square. Are you listening? Now this I have calculated. This see how much the curve moves leftwards toward y-axis depend on the correlation. If correlation is -1, through optimum portfolio proportion, the risk can even be reduced to 0. Okay, and these things I have discussed already. In that case, this will be the zero variance portfolio. Okay, now when correlation is +1, there will be no risk reduction happening. The curve will never move leftwards itself. It will directly move to right side. Are you all understanding? Okay, this is the efficiency frontier. One question in this regard, quickly we will summarize and move on. See, this question is there. Solution I was given. Efficient frontier already explained above. You can go through. Efficient portfolio. The portfolio will be most efficient when 75.95 and security A and 24.1% consist of security B. How this is calculated, I told you now, the same formula, proportion of A, proportion of B. This is a magical number. By applying the formula, you will get the number. I already know that, I calculated and put it so that you can understand the concept in a better way. Okay, are you all understanding how efficiency frontier is formed? Shall I move on? Okay, see. Efficient frontier, one more question we can do just, okay, this is the RTP question I was discussing about. Shall we? Okay, see what they're asking. 6 A, B, C, D, E, F, 6 different securities are given. Return on risk of 6 different securities given. Okay, which of the securities will be selected, or which, okay, you have to classify efficient and inefficient. Only efficient portfolios will be selected. Now I just told you. So efficient portfolio, now how you will select? Very simple. First, one by one we will take security B. If you notice, okay, security B is inferior to security A and security okay, see here what happens. Security B is inferior to security A, okay, and security E. How it is that? See, security B is giving a return of 8% by taking 5% return. Which means, see, instead of earning 8% return by taking 5%, security A is giving me same 8% risk for a lower risk, for 8% return for a lower 4% risk. Hence, B is inefficient security, inefficient than A. Also, E. Why E? See, B is inefficient to E also. Why? Because B is giving me a lower return for same risk. Okay, I also told you na second condition, which means for same 5% risk, B is offering only 8% return, whereas E is offering 9% return. Hence, the B is inferior to A as well as inferior to B. Hence, I will not invest in security B. Are you understanding? A gives same return for lower risk and E gives higher return for the same risk. Agreed? Next, come to security D. What happens? Security D gives me return of 4% and risk of 4%. This is also inferior to A. Why? Because A gives me 8% return for the same 4% risk. Yeah, are you all listening? So, which means, okay, D is inferior to A. Why? Because A gives me higher return for the same level of risk. Then come to F. Okay, what happened? Then D is also inferior. So, B gone, D gone. Come to F, what happens? F is giving me 8% return for 6% return, whereby I can earn 8% by taking only 4% risk from security A, portfolio A, which means what happens usually, F is inferior to A as well as E also. If you notice, E also, okay, you can earn more return, higher return for taking lower risk than 6%. For just 5% risk, portfolio E is earning me 9% return, higher return than portfolio F. Therefore, F is inferior to A as well as to E. F is inferior to A as well as to E. Hence, what are all the efficient portfolio? A, E and F. I can call it, A and E. A and E. Okay. C is efficient or inefficient? 1 second. What is that? Yes, 12% return for 12% return. C is not inferior to anything because, okay, see, you cannot find higher risk but compensated with higher return. Okay, for same risk, if they give the return, 12% return, if any security gives you 12% return, then it will be inferior. Hence, it is not inferior. So, security A, E, C, these three securities are not inferior to anyone, which means these three will form in the efficient frontier. This will be in the curve. This will be lining in the curve. Are you all understanding? Now, portfolio return if invested in A and C. Next part of the solution. This is first part of the solution. Which of the three securities? A, E and C will be selected. The solution over. Next, part 2, assuming perfect correlation. Perfect correlation, see, it can also be interpreted as perfect negative correlation or perfect positive correlation. Institute has taken a stand in his RTP. They have given plus perfect positive only they have considered and given the solution. Okay, it is put in study mat also recently. Earlier it came in RTP and then later they have incorporated this in recent study mat also from last year, I think. So, perfect positive correlation they have assumed and solved. Okay, perfect positive correlation they have assumed and solved. Okay. Now what do you do? See, if the correlation is perfect positive, how to solve? Very simple. When R is plus 1, I told you the portfolio risk formula will be simply W1 sigma 1, W2 sigma 2. Okay, it will be reduced, simplified, A plus B the whole square. So, the 2AB vanishes, entire thing vanishes. I told you simply A plus B, W1 sigma 1 plus W2 sigma 2. If you solve this, you will get portfolio risk as 6%. And okay, portfolio return is 9%. Weighted average return of the individual securities here I computed as 9%. Are you all understanding what I am trying to say? See, if invested in security A and C, they are asking see, security A 75%, security B 25%. If this is the proportion, security A is 75%, 0.75, security B is 0.25. What will be my portfolio risk and return? We need to find out. Proportion is 0.75. 0.25, return 8%, 12%, weighted return 6 and 3, 9% is the total. So, weighted average return for secure portfolio consists of security A and C with this 75 and 25% proportion is 9%. This is portfolio return. Agreed as per the question given. What is the portfolio risk? Now we just computed W1 sigma 1, W2 sigma 2, W1 75% weight, sigma 1 4%, security A sigma is 4%, security B C sigma is 12%, weighted average risk is 6%, which means this portfolio which I construct 75% A, 25% of security B will give me 6% return and 9% return for 6% portfolio risk. Now you tell me this is efficient portfolio. Why inefficient? Inefficient. Why? Because see what happens. Security E is giving me, if you notice, security E is giving me same 9% return for 5% risk, for 5% risk instead of 6%, which means the newly constructed portfolio of security A and C is there that also is inferior to portfolio E. So portfolio E is superior than this security, hence invest in security E alone. No need to construct this portfolio. This is the conclusion given for this question. Portfolio risk is 6%, portfolio return we have analyzed. Since security E is giving me just 9% return for just 5% risk, security E is efficient. This portfolio, this is an inefficient portfolio as it is inferior to security E. With this, we are through with this Markowitz portfolio theory. Are you all understanding? Shall I move on to capital allocation line? Okay. Next important discussion, carefully observe. Okay, we are going to discuss capital allocation line. Now we will discuss a small concept, that is capital allocation line. See, this was researched by Tobin. Okay, now we are slowly moving on to the various theories. Initially, Markowitz portfolio. What is the difference between Markowitz portfolio theory and capital allocation line? We will try to understand. See what happened. In Markowitz portfolio theory, we only considered individual securities. This is efficiency frontier, and below that, all these securities are inefficient, and all these portfolios of portfolio of securities are inefficient, and the portfolios which forms part of the Markowitz efficiency frontier efficiency frontier will be efficient portfolios, correct? Now all these below the portfolios below the efficiency frontier were all inefficient because for the same level of risk there will be higher return offered by the portfolio which is lying in the efficiency frontier. Are you all understanding? This we already understood, but all these portfolios consist only of market securities. In case of Markowitz portfolio theory, all these securities were market security, which means say Reliance, all the listed companies of the Reliance Limited, ITC Limited, Tata shares, all these shares are there, listed shares. Okay, this theory says that the portfolios which you are selecting are market portfolios, which means the portfolio will consist of securities which are inside the market. Are you listening? Now Tobin says, you need not only consider the market securities to create a portfolio, you can also consider risk-free assets. Risk-free asset. Assume Government of India bonds is there, risk-free bond na. So you can also create a portfolio which consists of risk-free asset as well as risky asset, a combination of risk-free asset plus risky asset. Are you listening what I am trying to say? Which means this was not researched in Markowitz portfolio theory. This possibility was not considered under Markowitz portfolio theory. Now Tobin tries to analyze how I can combine risk-free asset and risky asset and form a portfolio. And this can be superior also to Markowitz portfolio theory. We are going to learn how this is superior to that, how considering risk-free asset might be a better option than considering two risky assets. Shall I explain? See here. Now what happens? The efficiency frontier. See here. In the I have given notes, everything I have given notes, you can go through. In the Markowitz theory, we have not considered the possibility of investing in risk-free securities like government bond and consider only market securities. Risk-free securities, gives a return which has zero standard deviation. What is the risk of risk-free security? As the name suggests, risk-free securities will have zero risk. Are you listening? So risk-free asset will have zero asset. But what is the return? Risk-free rate of return. See, more risk, more return. Less risk, less return. Zero risk, zero return is there is some return that is called as risk-free return. The risk-free rate of return means what? The rate of return which you earn by investing in risk-free security. Risk is zero, but return, it will be some return, risk-free return, 7%, 5%, 6%. On an average, government long-term, Government of India bonds will give you this return. This return, which is called as RF return, will now become our base for portfolio selection, new base for portfolio selection. Earlier, we used to select two risky asset. Now we are combining risky asset with risk-free security. Are you listening? The investor will start drawing lines connect risk-free asset and securities in the efficiency frontier. These lines are tilted upwards and anti-clockwise till they find a line tangent to efficient line. Very simple. I'll tell you what happens here. This I have given for reference. This is frontier, this curve na? This I have given for reference. See one more thing. The capital allocation line, you have risk-free asset plus risky asset na. This risky asset na, one of the securities from the market you have to select. That also, you should never select the inefficient portfolios inefficient securities which you selected. Are you all understanding what I am trying to say? Which means the inefficient portfolio, inefficient securities which you disregarded there, you will not, you should not consider the same asset. Are you all listening? So those assets which are already, decided as inefficient in the Markowitz portfolio theory, those assets you will leave. But only those assets which is lying in the efficiency frontier, which is efficient security, that only you will consider again to construct this capital allocation line, and not the security which is already considered as inefficient. Are you understanding? So the risky asset which you are taking, that should be lying in efficiency frontier, which I discussed earlier. Are you listening and understanding? So now I will select one of the security from the efficiency frontier. In one of the question we saw na, which security, say inferior to A and E. So A, E and here A, E and C we selected na, which means this security A, E and C is a group of securities. Out of these three securities, out of these portfolios or security, I will select one of the security and then combine it with RF. Are you all understanding? Either I select E plus RF, I select C plus RF. Like this, I will combine one of the risky security from efficiency frontier and the risk-free asset, and I will combine the line, and I will get, okay, the new frontier turns out to be line instead of the curve. This was curve now earlier. This will become the line. The line will replace the curve. How it became line now? Very simple. Okay, for computing the risk and return of the portfolio which lies in efficiency frontier, we used correlation as minus 0.2 in the question. Correlation need not be always minus 1 or plus 1. Are you all understanding? If correlation is minus 1 exactly, then also it will be straight line, because a plus b the whole square summarized a plus b, correct? It will become, if correlation minus 1, the formula portfolio risk formula will be summarized and it will be simply a minus b. Are you all understanding? W1 sigma 1 minus W2 sigma 2, right? If the correlation is exactly plus 1, then it will become W1 sigma 1 plus W2 sigma 2. A plus b, the whole square root of a plus b the whole square, a plus b simply. Are you all understanding? But in case when correlation is not exactly plus 1 or minus 1, if the correlation falls between these two numbers, it will always be curve. Are you all understanding? Now, when you combine risk-free asset, two things will happen. You tell me, children, what is the sigma of risk-free asset? See, standard deviation of risk-free asset is 0. I already told you, I have given in notes also, because, okay, see here, risk-free securities, as the name suggests, it is risk-free. Okay, a standard deviation, it will deviate. Every year the return will be same. Yeah, it will not deviate. So there is no deviation. There is no risk. That is why it is risk-free asset. So first thing, risk of the risk-free asset is 0, and the correlation between risk-free asset and risky asset is also 0. Why? Because no correlation. Yeah, risk-free asset and risky asset, there will be no correlation. I told you, right? Which means if the correlation, okay, R of risk-free asset and risky asset becomes 0, the entire, okay, 2AB is there, na? A square plus B square plus 2AB, the 2AB term will become 0. Hence, okay, it will also be A plus B the whole square, square root of A plus B the whole square, which is nothing but A plus B. Are you listening what I am trying to say? And there also, A plus B also, okay, see, I'll show you. What is the standard deviation of the portfolio, which consists of, here I can show you, see what happens. What is the standard deviation of portfolio which consists of, okay, risk-free asset plus risky asset. Now you tell me, what is, assume this risky asset is A, correct? The standard deviation of the portfolio formula will look like this. I will elaborate and then I will cancel it off. Okay, see, very simple. See, this is RF na. So, okay, W1 square, okay, RF, sigma RF square plus W2 square, okay, sigma A square. In this case, risky asset, I am putting it as A, plus 2 into W1, W2, sigma RF, sigma A, okay, and correlation of RF and A. This would be the formula, na? Portfolio risk formula. Now, I already told you, correlation between risk-free asset and A is 0, which means the entire term will become 0, irrelevant. Agreed? Same way, the sigma RF is also 0, and this will also be 0, and simply, okay, the portfolio risk formula will be nothing but, okay, weight of risky asset, weight 2, okay, square root of weight 2 square sigma A square, or, okay, the standard deviation, it is nothing but weight 2 sigma A. Are you all understanding? Which means this is nothing but weight of risk-free asset, WRF na, weight of risk-free asset into sigma of weight of risk-free asset, weight of risky asset, weight of A, I can call it as weight of A, okay, weight of A into sigma of A, risky asset. This will become the portfolio risk formula. Are you all understanding? Now, this will be linear line. This will be linear line since there is no curve deviation. Okay, with regards to correlation effect will be nullified and there will be no curve. The efficiency frontier gets replaced by line. From here onwards, okay, this is capital allocation line. Next we are going to learn capital market line, then SML, security market line, which is nothing but CAPM. Everything will be line. Okay, the curve gone. Okay, the Markowitz portfolio theory, the efficiency frontier will get, now the efficiency frontier will get replaced by the capital allocation line. This we call it as capital allocation line. Now, so this is the capital allocation line. Now what it tries to find out? Very simple. What is the portfolio risk and return when I combine the risk-free asset with risky asset. This is what capital allocation line is all about. Now the question arises, one thing, see, I'm just rubbing it for the clarification. See, what happens, carefully observe, okay, now I need to find out for any, research, that the problem is two things we need to solve. One is what is the portfolio return and what is the portfolio risk. Are you all understanding? So portfolio return and risk I need to find out now. How to find out? Portfolio return, okay, return of the portfolio is nothing but weighted average return of the individual securities inside my portfolio. Up weighted average security na weight of RF plus weight of RF into return of RF, okay, which is risk free return, plus weight of risky asset into weight of, okay, into return of risky asset, risky asset, okay, RS na risky asset. Are you all understanding? This is what you call it as portfolio return. Portfolio risk also I have just now I discussed na same way. I have given this here. Please observe. Portfolio return, how to compute? Very simple. Security, proportion, return, weighted average return of the individual securities. Proportion of RF into risk-free asset, risk-free return, weight of RF into RF plus weight of security, risky security into return generated by the risky security, you will get the portfolio return. Are you all understanding? Same way, two risky security, how you calculate it. Same way here also, risk-free security plus risky security, you will find the portfolio return. Now come to portfolio risk. Portfolio risk entire formula I have given. Again, since sigma RF is 0, the formula becomes simply, okay, see here, portfolio risk formula simplifies to WS sigma S. WS means, okay, weight of risky security. Okay, the first portion also gets vanished because sigma is 0 and correlation also 0. The entire 2AB portion also get vanished. Simply portfolio risk become weight of risky security into return generated by the risky security, weight of S into sigma S. Okay, simplified version. Are you all understanding? And one more interpretation, this is portfolio risk. So we have portfolio return, how to compute? We know how to compute portfolio risk. Both very simple and straightforward. No issues, no big formula is required. Are you all understanding? Now, one more catch is there. See, this formula is nothing but weight of, see, what is this? I will again elaborate here. See, portfolio risk, sigma P is what? Portfolio risk is equal to weight of security, risky security into, okay, this is the sigma of risky security. Are you all understanding? Now, the point is, if you rearrange this, you will also get weight of the securities for the portfolio, which means, see, very simple. Okay, now, if the portfolio risk is given, if the question mentions portfolio risk, say portfolio risk should be 25%. If the question mentions you portfolio risk, okay, how much of the security, how much proportion, how much should be the weight of my securities inside this portfolio? And the question may ask you. Are you understanding what I am trying to say? If the question asks you to compute portfolio risk, you simply weight of the security will be given, weight of this risky security into sigma of this risky security will consider and find a portfolio risk. But conversely, if the question asks you to compute weight of the risky securities to be included in the portfolio, whereas the portfolio risk will be given, which means if the question is asking you to find out the target risk of the portfolio, you see how much of the risky asset you should include in the portfolio so that my portfolio risk becomes 25%. If question mentions you this, are you all understanding? Now what you should find? Weight of the security, risky security. Just to rearrange, weight of security, see, sigma P is equal to weight of security into sigma S. So weight of security is nothing but sigma P by sigma S. Are you all understanding? This is sigma P, the target portfolio risk, which question mentions, divided by, okay, sigma of the individual security, risky asset in the security. If you do this, you will get the weight of the risky asset inside the portfolio. And how to find out weight of the risk-free asset? Very simple, 1 minus WS. Are you all understanding? If only two securities are considered in a portfolio, if weight of risky asset is 60%, what is the weight of balance RF? Balance 40%. Like this, you need to calculate. Are you all clear with this? One question we will do, absolute full clarity will be there. Okay, one good quality question we will do. Okay, and we revise this. And are you all understanding? One question is to be answered finally. Sir, I understood this point. Okay, I understood that till here. Okay, this is called as point of tangency. Point of tangency. Okay, that point of tangency is where, okay, the portfolio which is lying in the point, exactly point of tangency, will be indifferent between capital allocation line and efficiency frontier, which means as per Markowitz portfolio theory, okay, whichever portfolio you selected, it exactly lies in the, okay, point of tangency, which means these two lines meet each other, which means the capital allocation line and efficiency frontier touches na. This is called as point of tangency. At this point of tangency, assume there is a portfolio X. Agreed? This portfolio X, okay, will be indifferent. The risk and return of this portfolio will be equal as per capital allocation line, as per efficiency frontier also. Are you all understanding? Now this is point of tangency. Main question is to be answered. So I understood that this line can be drawn from RF to this line. What is this extended line all about? Why is this line extended above that? Are you all understanding? The question arises now, which means more risk, more return, more risk, more return. The line is getting extended now. How it is possible? What is this extended line represents? This represents borrowing. This represents levered portfolio, which means, okay, if you borrow, okay, if you borrow and invest in risk-free security, are you all understanding? If you borrow Government of India bonds, risk-free asset, if you borrow, okay, assume you have 200 rupees in your hand, 100 rupees you borrowed from bank, risk-free asset you borrowed, and you invested 300 rupees in the market security. You tell me, children, if you invest in risk-free asset as well as risky asset, your risk will get reduced because some portion of your money is invested in risk-free asset and some portion of your money is invested in risky asset. Your portfolio risk will get reduced. But okay, if you borrow from a risk-free asset, if you borrow risk-free asset and invest in risky asset, 100 rupees, 200 rupees you had in hand, 100 rupees you borrowed from bank, 300 rupees, entire 300 rupees you invested in risky asset, which means you are more leverage na. Okay, it will add to financial leverage. So which means, okay, the risk will be increased. The risk will be further increased because of the leverage. Hence the line will get extended. That is why if you see the x-axis, it goes most right on na, more risk, and the line also goes above. Upper y-axis goes above, more return, more risk, more return. Are you all understanding? This is the okay, this is the leverage, borrowing and investing is called as this capital line, extension of this capital allocation line. This is ditto same. Why I am explaining all this in capital allocation line? Okay, in your material also you will not see. But there is a question regarding capital allocation line. If you don't know capital allocation line, you will never understand. The question has been asked from this concept. Okay, from this concept only, capital market line, CAPM, okay, all these theories get improvised. We are going to learn about all this theory. It will be very easy. Now you understood. I'm not going to explain again and again. When it comes to CAPM, you will have absolute clarity about all these diagrams. Are you understanding? Okay. Now we will move on to one question. I have given this question not here. Capital market line also given because both are approximately same theory. Only the security will get replaced by market. We will learn about that concept later. Now we will do one question regarding capital allocation line, which I have given under capital market line. Okay. Anyway, we will solve the question and then come back to capital market line, shall we? Okay, see here, take question number 11, which I have given here. Okay, even though the question number may not be in order, okay, don't worry. I have given based on the number which is used in our workbook. Okay, so for reference purpose, I have put the same number. It may not be in the same order. Okay, no issues. Maximum return for given level of risk. This question, very, very beautiful question. Okay, which combines the concept of efficiency frontier, Markowitz portfolio theory, and capital allocation line. Very, very beautiful question. See here, we have portfolio A to H. 1, 2, 3, 4, 5, 6, 7, 8 portfolios is given. 8 portfolios are given. Okay, return and risk of 8 different portfolios are given. Simple. Okay, point 1, which of the portfolio are efficient and which are inefficient? This simply asks about Markowitz portfolio theory. Okay, you need to find out efficient portfolio and inefficient portfolio, segregate it, which will be efficient and inefficient. This is exactly same here, solution also given. Okay, just discussing. Security A is there. You tell me, children, security A is efficient or inefficient? Security A is giving 10% return for 23% risk, whereas security B, if you roughly see itself, you can understand, it is giving more return, okay, by undertaking less risk, which means you tell me which is okay, A is inefficient compared to B. A is inefficient compared to B. A is inferior to B. Come to B. Now B is giving 12.5% return for 21% risk. Efficient or inefficient? Efficient, because there exists no other security which offers okay, same return or higher return for lower risk or same risk. Are you all understanding? Okay, I told you 3 conditions are to be met. Okay, to find the securities to be efficient or inefficient. We will compare. Next, security C you take. What happens with security C is that, okay, it gives you 15% return. any other security which gives at least to 15% return, okay, by taking more risk? No. See, D, E, F, G, H, all these securities are giving more return than security C. But problem is, they are having more risk also. Hence, for the same level of risk or lower risk, they are not offering higher return. Hence, C is also efficient. C is also efficient because it is inferior to none. Are you understanding? Next, to take D security. D for discussion. What happens? It gives 16% return for 29% security, whereas E gives higher return for same level of risk. I told you na, higher return, 17% return for same 29% risk. Hence, E is superior than D. D becomes inefficient to E. Okay, next take E. E security is there 18%. Is there any other security giving 18%? Yes, G is giving 18%, but for a higher risk, 32% risk, not 32% risk, it is giving for 35% risk, which means not for same level of risk. Okay, F is efficient, F is efficient, inefficient to none. Take G. What happens with regards to G? It is offering 18% return for 35%. F is offering 18% return for a lower risk, 32% risk. So G becomes inefficient to H, F, correct? Next, take security. H is offering more return for more risk, and of course it is efficient. Are you understanding? So all these data given. First part of the question asked about efficiency frontier, which is efficient portfolio. Okay, Markowitz portfolio theory they are testing. Okay, point number A. Come to point B. Suppose one can tolerate a risk of 25%. What is the maximum return one can achieve if no borrowing or lending is resorted to? See, the second point, what they are asking, suppose one can tolerate risk of 25%. Okay, there are in between few concepts which I cover in regular lectures, which is, if you have to have the absolute clarity in all these concepts, you have to take regular lecture. Okay, in the revision lecture, I'm covering 80% of it. I'm trying to cover 70-80% of what I discuss in regular lecture. But see what happens here. After explaining the efficiency frontier, there are few more discussions based on in my efficient portfolio, investors' efficient portfolio, how investors will be different, their risk perception will different, we'll classify different investors. Okay, these things I used to discuss. Now, what is the point? The question 2, what to say? See, I have so many instruments available in the market, A to H, correct? Now, the risk tolerance will be different for different investors, which means I can tolerate a higher risk. See, younger people will tolerate higher risk. Older people, if you ask them to invest in share market, they will never invest in share market. They will always put in real estate or gold, safe havens. Okay, we call these assets as safe havens. They will invest in these securities and they will not invest in market. Okay, it's too risky, share market invest money, who will lose the capital? So they will not be willing to take this, old age persons, correct? If you see the young persons, they will try to take risk because anyway they would not have earned much. Okay, they will be willing to take risk even if there is no earnings. Okay, just for earning persons, professionals will also invest in equity markets, no issue. Now the point is, the point is every investor will have their own risk tolerance. Risk tolerance will be different from each investor's perspective. So if I have a risk tolerance of 25%, what the second question is asking, if I have a risk tolerance of 25%, see, I have in the market 8 different securities now. Suppose I have only 25% risk tolerance. If I have the risk appetite of 45%, if I have the appetite to take 45% risk, I can take security H for investment, correct? And earn 20% return, fine. It is appealing. More risk, more return, fine. But if I have only, appetite to take only 25% risk, I cannot take 25%, I cannot take beyond 25% risk. Okay, what can be the maximum return you can earn? The C gives you 15% return. Are you all understanding? This is what the question is testing. Unless you know the concepts well, okay, you will not understand what they are asking. See, suppose one can tolerate a risk of 25%. What is the maximum return one can achieve if no borrowing or lending resorted to? Suppose I am not borrowing and lending anything. This is the third part is borrowing or lending can be resorted to if 12% is the rate of borrowing or lending. C part is asking about capital allocation line. I told you the extension, capital allocation line, levered line. That they are testing in the third part. The second part they are saying, no, we are not. We are saying the maximum tolerance limit is 25%. What is the maximum return can earn by investing in C, which is efficient portfolio? Maximum return is 15%. Second part of the solution. See, if the investor is willing to tolerate risk of 25%, he can earn a return of 15% by investing in security C. Is this clear? Shall I proceed the third part? Very, very important discussion. Last part. See here what they are asking. Suppose one can tolerate risk of 25%. Same risk tolerance is 25%. Now, what they are saying, my portfolio risk should be maximum 25%, not more than that. My portfolio risk should be limited to 25%. I told you while explaining, in the question they would have implicitly given you the target portfolio risk. Okay, you should work out how much the weightage of the risky security I need to put now, the same thing. Okay, what is the maximum return one can achieve with borrowing or lending at the rate of 12% is return. So risk-free rate of return is 12%. Borrowing or lending can be done. You can borrow at 12% or invest at 12%. This is risk-free asset. You can combine any risky asset with this 12% borrowing or lending, but you should achieve 25% portfolio risk. What would be the maximum return I can earn by taking 25% risk, and that risk arises from borrowing or lending and investing in individual securities? Are you understanding? Which means either invest in security and invest in risk-free asset, combination of investment in risk-free asset and investing in risky asset, or it might be a combination of borrowing from risk-free asset, investing in further risky asset. Are you understanding? Say, this we need to compute now. So all of these 8 portfolios we will consider. Okay, different options. So A is there, B is there, C is there now. What we'll do? A plus RF, B plus RF, C plus RF, D plus RF. Like this we will try to include risk-free asset in all of these securities, and we will fix the target portfolio as 25% and inject the risky asset into the portfolio. Are you understanding? And find out the portfolio risk and return, and I will compare, find out whichever is giving me highest return for the 25% of the risk. Shall I? Okay, see here what we are going to do. First step is to find out the proportion of investment in security and risk-free asset. Agreed? Now risk-free asset and risky asset security proportion we need to find out. For that, how this proportion is to be calculated. Okay, first step now, what they have given in the question, they have given portfolio risk should be maximum 25%. The tolerance limit is 25%. Now my target portfolio risk should be 25%. Agreed? How can I build a portfolio which is having 25% tolerance limit, risk limit? Very simple. That's why to have a portfolio risk of 25%, how much of the risky asset I should include, first you need to find out. That is very simple. That is why I explained the formula. WS is equal to sigma P divided by sigma S. Are you all understanding? If you do this, you will find out weight of security. That's why I have given this in capital allocation line. Your notes you can go through. Okay, so portfolio risk is 25% divided by sigma S, means what is the sigma of the security you need to find out, which is security 23. Are you all understanding? Agreed? So portfolio, so A plus risk-free asset, assume first category A plus risky asset. Now we need to find out. So what will be the proportion of A, security A, when you are constructing security A plus RF? Here what happens, okay, you need to find out whether you are borrowing or you are investing. That later only you can find out. First you will include A in the portfolio. What is the proportion of A you need to find out. Portfolio risk is 25%. What is the proportion of A? 25% risk of the portfolio divided by risk of A. Risk of A is how much? 23. 25 by 23 is the proportion of security A to be included in the portfolio. Sir, I have only 23 rupees in my hand. How can I invest 25 rupees into 25 by 23 means what? 25 rupees I invest in security A. Okay, but I have in hand only 23 rupees. Now, how I can invest 25 rupees in security A? Very simple, you borrow 2 rupees. Are you all understanding what I am trying to say? See, 25 by 25. Now, if you have 25, entire 25 is invested, this is 1. Weight will be 1. 100% amount will be invested in security A. Agreed? Now, if you are investing say 25 rupees in security A, correct? But only 23 rupees you have in hand, which means what you should do? You should borrow. 2 rupees from risk-free asset, which means you should borrow 2 rupees and you will invest. Agreed? You will borrow 2 rupees. Okay, which means if you borrow now, the sign will be negative. So how will be the weight now? See, very simple. I will explain here. One or two cases I will explain. Thereafter you will understand. See, the first case, first step, what is that? Weight of security as you need to find out. How to find out weight of security as risky security? Portfolio risk, target portfolio risk, which they mentioned as 25% divided by sigma S. Sigma A, in this case A, correct? For security A and RF. A and RF. Like this I need to find out. First step, 25 is the portfolio risk, 25 is the portfolio risk divided by 23. Agreed? Now I have only 23 rupees. How can I achieve 25 by 23? Okay, this is weight of security S. What will be the weight of RF? Is nothing but minus 2 by 3. Are you all understanding? 25 by 23 minus 2 by 23 will give you, okay, 23 by 23 or 1, which means 100 rupees you have in hand, 2 rupees you borrow, okay, or 23 rupees you have in hand, 2 rupees you borrow, invest 25 into risky asset, 2 rupees borrowing will be there. Upper 2 by 23 will be the weightage of RF. Are you all understanding? So weight of risky asset will be 25 by 23. Okay, RF will be, weight of RF will be minus 2 by 23. Are you all understanding this weightage? Okay, now if you combine this will become 25 minus 22, 23 by 23, which will be 1. The total of the proportion will be 1. This is how you will combine. So now what we will do, we will find out return. Return generated by this portfolio, how to compute? Very simple. Return of the portfolio is nothing but weighted average return of the individual securities inside the portfolio. Now we got the weight. This is nothing but weight. We have the return for A and RF. RF, what is the return for A? Please see the question and check. What is the return of A is 10%, RF is 12%. Return of A is equal to 10%. Okay, RF return is 12%. Now, how to find out a portfolio which is having this proportion, the return of this portfolio having this proportion? 25 by 23 into 10%. How much is that? Please take your calculator. Okay, 10 into 25 divided by 23, 10.86%, correct? Plus weighted average return of the individual securities inside the portfolio. You have also RF, Now, plus or minus borrowing, minus 2 by 23, Okay, minus 2 by 23 into 12% RF. Yes, 12%, which means 24 divided by 23, 1.043. Okay, the plus will become minus 1.043. How much is that? Please tell me. 10.86, okay, minus 1.043. How much it is? 9.817%. Are you all understanding? This will become the portfolio return, which includes risky asset as well as risk-free as 9.83. Okay, rounding off. See here, 12 into 2 by 23. Okay, 10 into 25 by 23. This is how you find out. So A and loan. Why I given loan? Wherever wherever your capital is not sufficient, you will borrow, So minus 2 by 23 weightage, So hence loan. If there is investing, I call this investment, INV, investment in RF. Okay, all these things we will compute. So again, this is for security A and RF. This is for security A and RF. Portfolio return comes to this much, 9.83. In all these cases, A plus RF, B plus RF, C plus RF, D plus RF, you are including risk-free asset into the mix, and the total portfolio sigma will be 25. The total portfolio risk will be 25. There is no, because the question itself mentions for the maximum given level of 25% risk, how much the best portfolio will be. What is the return which can be earned by one of these one of the portfolios? Are you listening? That will be selected. Now, B plus loan. If you take B plus loan, what happens? 12.5% is a return earned by security B into 25 by 21. See, come to the proportion here. Come to B's proportion. How will you find out? Very simple. Sigma P 25 divided by 21. 21 is the sigma of the security. Sigma of the B. Can you see this? Sigma of B is 21. So 25 by 21 becomes a proportion. Again, borrowing, investing, borrowing. Why? 25 by 21. You have only 21 in hand. Denominator 21 in hand. 4 rupees you have to borrow and invest 25. More than 1. So what you do? Minus 4.4 by 21. Okay, you will borrow risk-free asset. Again, B and loan. Are you all understanding? B and loan. Okay, 25 by 21 and minus 4 by 21. The proportion, are you all understanding? This is a very, very important working here. Okay, the proportion you need to understand. Say, next to C. C, risk is 25. Portfolio risk is also 25. I need not bring any RF. Okay, RF is 0. Proportion of RF is 0. Literally, I only invest in security C. Okay, come to D. D here, you have portfolio risk of 25. But overall risk, if you see of the security, D security is 29, which means I should reduce the risk. Portfolio risk is 25. Individual securities risk is 29. Portfolio risk is only 25. So I need to bring down the risk. What I should do? I should put the money in RF, not borrow. Borrow, it will increase the allocation line. It will increase the risk. Very simple, When you borrow, it will increase the risk. When you invest in risk-free asset, it will reduce the overall portfolio risk. You are to reduce the portfolio risk, overall portfolio risk from 29 to 25. So invest in RF 4 by 29. Up 25 by 29 becomes the proportion in risky asset. 4 by 29 becomes the weight of risk-free asset inside the portfolio. So D and investment in RF, okay, proportion of D is 25 by 29, okay, the portfolio risk, the risk of D is how much? Risk of D is 29, hence, okay, 25 by 29 should be the proportion of D. See here, I've given na, yes, D, okay, 25 by 29. If D is 25 by 29, the proportion of D in the portfolio is 25 by 29, then risk-free, borrowing or lending, okay, or investment or borrowing, investment. 25 by 29 is the proportion of D, and RF, what is the proportion of RF? 4 by 29. Are you all understanding? So now 4 by 29, so this amount 25 by 29 generates how much return? 16% return, and balance 4 by 29 generates okay, 12% return. 16 into 25 by 29 plus weighted average return, 12 into 4 by 29, 15.445%. Like this you will find for E and RF, F for F and RF, G and RF, H and RF, and the respective returns, okay, you can calculate. Now whichever is the highest what is the portfolio giving highest return? Which portfolio is giving highest return? F and RF. F and RF gives me highest return of 16.69%. I think no other portfolio gives such return. Yes, for a given level of 25% risk, for a given level of sigma P, portfolio risk is 25%. What is the maximum return I can earn by combining RF along with all these assets, any of these assets? F and RF, if I combine and invest, I am getting 16.69%, which is for 25% is the highest return. Are you all understanding? Is this clear? Okay, this is the question, very beautiful question, okay, regarding Markowitz portfolio theory as well as, okay, capital allocation line. Now we will move on to the next topic, that is capital market line. Capital market line. See. Okay. Now you have understood, okay, how the frontier is replaced by line and how the risk-free asset is combined with risky asset to form capital allocation line. In the next stage, capital market line, okay, what they are trying to do now, see, after a few years, okay, initially Markowitz came up with this Markowitz portfolio theory in 1952s, early 1950s, and thereafter these theories, okay, got evolved. Thereafter, okay, instead of individual securities, people understood that market is superior. In the short run, few securities can beat the market. Okay, the person called as John Bogle, okay, came up with a beautiful research. Okay, index funds and all these were very popular. And what happened, that they researched and using the data, they found out that for the past 40, 50, 60 years, okay, you cannot beat consistently markets. Market in the sense the Nifty or Sensex, which is the stock market, barometer of the country's economy, index. Okay, the indices available, okay, whatever, in India there are two indices, index and Nifty and Sensex, correct? So in the short run you can beat the market, but in the long run on a consistent basis market cannot be beaten. So market should be taken. Okay, the risk or return of the individual securities which we are considering now, X, Y, Z, like this individual securities till now we were considering in the Markowitz portfolio theory capital allocation line. In the capital market line, the entire the individual security vanishes and the market replaces. Here only, okay, these models are called as market based models. Capital market line, okay, SML, security market line, which is nothing but CAPM, capital asset pricing model. Okay, then we have arbitrage pricing theory, or we have sharp single index model. All these are called as index based model. Okay, market line, that's why you can see the term market line, capital allocation, capital market line. And then SML, security market line, this is nothing but graphical representation of CAPM. There also market, okay, everywhere. Sharp single index model, the index you can see na, the market models there are hereafter replaces, which means, see, very simple, in the Markowitz portfolio theory, earlier what we had, only market based security A, B, C, up a portfolio will be considered listed companies which are which are inside the market, okay, individual securities, correct? We form portfolio. Then in the capital allocation line CL, what we did, okay, individual securities inside the market we considered A plus RF, B plus RF, like this we included a risk-free asset. Now, okay, how the theory got developed now, the A, okay, B and all got vanished, simply replaced by market, okay, which means, okay, RM, I call it as RM and RF. This is return of the market, this is return of the risk-free return. Are you all understanding? This will be common for all these market-based model, which means A, instead of A, I assume the market, nothing but market, okay, index. Then B, C, no, I will include market and risk-free asset and form capital market line. Are you all understanding? This is how, this is entry into index models. All these, from here we start index-based models. Now, there are few assumptions in CML. This is very imperative to understand so that you can understand further CAPM and all. Okay, this is not only relevant for CML but also for SML. Okay, SML in the sense, this is nothing but CAPM. CAPM is only called as SML. CAPM, capital asset pricing model. Model is CAPM. The SMS, the graphical representation of CAPM is SML, called as SML, security market line, which you are going to study in the CAPM model. Here it is CML, capital market line. There is one more CML in case of sharp single index model we are going to learn, okay, which is characteristic market line, This is capital market line. Are you all understanding? Alpha plus beta into beta RM plus error term that we will learn now. That is nothing but, okay, characteristic market line, CML. Okay, right. Now, what are the assumptions? Basic thing, quickly I will discuss, then I will discuss the index, how index is formed based on market capitalization. Okay, then we will move on to capital asset pricing model. Okay, shall I? See, all the investors are rational. They invest based on mean variance analysis. Basic assumption is all investors are rational. Mean variance analysis, okay, basic mean variance analysis, now this basics of statistics. We will assume that all the investors know how to, okay, find out the risk based on mean variance analysis. Are you listening? There is no other criterion for selection of a security other than mean and variance, which means, okay, for computing the expected return, I will assume that everyone knows this methodology, statistic methodology, and I will assume that mean variance analysis is the only methodology for analysis. Are you understanding? Okay, there might be another many ways, but then we will assume for these models, for any theory to be proved, okay, you need to have some basic assumptions. This is the point. Next, all investor risk covers, which means risk covers in the sense I told you, three types of risk, investors are there: risk neutral, risk covers, and risk takers, risk lovers or risk takers. Okay, risk covers is a person who will never be ready to take, he will not be willing to take risk, but only he will be willing to take risk only in one case, when you compensate through adequate return, higher return, which means an investor will only take higher risk if he is adequately compensated for the higher risk. Listening, understanding the point, which means if you want to lure this risk averse investor to take additional risk, you have to compensate him for additional by paying additional return. Okay, this person is called as risk averse. Are you listening? They will generally don't take risk unless higher return, substantial return is offered. So they always require a premium for taking risk. This is the point. Next, markets are perfect. All investors have same information regarding the stocks. Okay, insider trading and all not allowed. Okay, markets, we assume that is perfect, which means the information which is available in the public, everyone is having the information available in the public. Okay, all the investors are having the same information. Due to this, all of them have some expectation with respect to return and risk of the security, which means the expectation of the investor also remains same. This is all basic thing. But you see, these are all assumptions. Reality, it will happen or no, it will not happen, because everyone will have different expectation when you come to market. Okay, few players will be purely speculators. Few will be coming to the market for hedging purpose. Few will be investing. So the intention will be different, but we will assume that everyone will have same expectation regarding return and risk. Same, everyone will be mostly risk averse. Everything, these are all assumptions, which means I'm trying to bring in uniformity for the investors. Are you understanding? Say, based on investors. No investor is big enough to individually influence the market. This also is hypothetical assumption. If you see big fund houses, mutual fund houses, they have crores and money. Billions of money they will pump into the market. They can easily, increase the prices, decrease the prices, anything they can do. Bulk investors are there. So individually no person will be influencing the market. Now it is not true. In practical sense it is not true. Big HNI investors or big FIIs or DIs, okay, domestic institutional investors, they have big power in the market. But still we will assume that every investor are rational and they are not big enough to, individually invest, change the market. Investments are infinitely divisible, which means see index funds are there. Okay, in today it is possible, but if you see the index is 26,000, 25,000 points, some points are there, then these all points I explained. So if only you have this index based funds are worked in lots, they can only be purchased or sold in lots. Lots means you have to have some substantial portion of money. 7 lakh rupees only if you have, you can, just like in trading in futures I told you, you have to have big chunk of money, then only you can invest. Okay, margin you can deposit some amount, but the volume of the trade, okay, should be big enough. but we will assume that they are infinitely divisible, which means even if you have 100 rupees, it is assumed that proportionate investment can be made. Now there are so many index based mutual funds. Of course this is true. This is now it became the reality. Earlier it was not there, so assumption. Now there is no need for assumption. Index funds are there, so easily you can say it is possible. Investors can borrow and lend at the same rate. This is at RF. Okay, generally at RF, right, investors can borrow and lend at the same rate of RF. In the previous question we saw, like while solving capital allocation line, I give you one question. There RF assume the lending and borrowing rate is 12%. Never in the world lending and borrowing rate will be same rate. Okay, lending rate will be always higher than lower than borrowing rate. Are you all understanding? Which means the customer's borrowing rate will be always higher, okay, than the lending rate. So this is also assumption. Okay, you can always assume you can borrow and as well as invest in the same risk-free rate of return. No transaction cost during buying and selling of the security. This is also just assumption because you need to ignore these transaction cost basically, but of course you will have transaction costs in all the buying trade. Anyway, these are all assumption which is also there, which will be relevant for capital market line as well as CAPM as well as for index based models. Okay, the sharp single index model. So all these assumptions hold good. Shall I proceed? Okay, now what is this market portfolio? Okay, for understanding this market portfolio now the return of the market which is represented by RM is called as market portfolio. I told you, if you don't, and I don't want to again and again discuss this. Okay, I have discussed in the equity valuation introduction chapter. There you can go through the same playlist. You will have the equity valuation chapter. There I have revised and told you what is market, how it is formed, index is formed, all I have explained there. Please go through and come back. Okay, I am not going to explain again and again, waste on time here. Okay, see, very simple. We have two indices, Sensex and Nifty. Sensex consists of 30 top stocks. Nifty consists of top 50 companies. Are you understanding? So which means, why is this saying market is superior? Now, very simple. If you have undervalued security in the stock, the basic concept I will just briefly explain. If you have 50 security, Nifty 50, now 50 securities inside the Nifty. What will happen if one security is undervalued? For example, Britannia Industries or Reliance Industries is undervalued. Okay, people will, what will happen initially, the return is assumed, the return is very low. People are ignoring the stock. What will happen? Everyone, sir, the question arises, now see what happens, this is efficiency frontier. Sir, you told me only people will select from this security from efficiency frontier. Upper inefficient securities will be there in the market also. So what will happen? Why you are considering market in this market based model? Okay, you told that only you should select efficient securities in the market. Now in this market model, entire 50 securities, some securities may be inefficient also, na? There only I need to explain one concept. Listen, what happens? Assume out of this 50 security, only 4 to 5 securities are efficient. Everyone buys for these 4 to 5 securities, na? Everyone in the market, okay, tries to buy the undervalued security, efficient security. They will jump and buy the undervalued securities. Correct? Demand for the undervalued securities or what efficient securities will increase. What will happen? The prices will go up. Are you all understanding? Everyone willing to buy the efficient security, na? The prices of A, C, D and E, assume these are efficient securities. These securities prices will shoot up in the market. Thus, the price will go up, na? Thereafter, it will become unattractive. Are you all understanding what I am trying to say? Which means, as soon as the price goes up, thereafter, there is no attraction, yeah? There is no undervaluation. The price will move up because of the higher demand. Slowly, the people will shift their investment to the undervalued security, which is, okay, the inefficient securities also people will start buying. Are you all listening? Because their price will, the demand will reduce, their price will even become cheaper. When their prices become cheaper, okay, they will become undervalued and people will start buying those securities also. Ultimately, even those securities will also be pulled up. All the securities in the market will be efficient one day. Are you listening what I am trying to say? So the efficiency or inefficiency of these securities are just a part-time thing. Okay, over a long run, every security will become efficient. Are you listening? This is the basic theory, underlying theory. Okay, see here, I have given all this here. Okay. Due to this, there will be no demand for other securities in the market, and when the demands for these securities fall, the prices also drop, making them more attractive and increases their return. In the course of time, they will also become efficient and all the securities will be efficient. This I have explained in the notes. You can go through simple thing. Okay, everything lucid manner I have explained here. No issues. Now the point is, okay, yes, this also I explained. How can a small investor with lend money in all securities in the market portfolio? Sir, market portfolio consists of 50 securities. You told, okay, you have to invest in all the security. Now, how a small investor will have the money, all these things, mutual fund, index fund, okay, the concept of index fund, fraction of share also can be invested in US markets and all, fraction of shares also can be invested. So all these are there. These I have put it in notes. Everything I have explained, I have put it in notes, no issue. Now we need to understand index, how index is formed. See, basic understanding I'll give you. Why this is, don't think all this I'm discussing for capital market line, no question is there, no. This discussion is common for capital market line as well as the succeeding capital asset pricing model, SML. Are you understanding? Security market line is also relevant. Now, this is a common discussion. Okay. Now, how the index is formed? This also I explained in basic concepts. See, what is there? Index can be formed using various methods, but predominantly in most of the markets, market capitalization method is followed. Market capitalization method, now very simple to put it. See, initially while index started, it was 100 points. Okay, this Sensex. Okay, 1979, Sensex was 100 points. From 100, it is now 25,000 odd points. I told you index, Nifty, Sensex, all these are points, not rupees. Okay, that you need to be very clear. So it started from 100, it reached to 25,000 points. It is, to put it simply, it is nothing but your index capital, capital gains, income tax, capital gains is there. Okay, there the index will be there. Correct? For indexation benefit is there for computing capital gains. Okay, indexation benefit will be considered for indexed cost of acquisition will be considered to deduct, correct, to find out capital gains. There indexation is there. How will indexation be computed? Same manner here also indexation will be computed. Very simple. Assume this is 100. Initially the index point is 100. Okay, this is year 1 year 0. Today index point is 100. Now at the end of year 1, what would be the index point? How to compute this index point? You need to find out. Very simple. What I do, 2 securities are listed in the market. Assume 2 securities are listed in the market day 1. Okay, market 2 securities are listed, security A and security B. Security A is having 100,000 shares and the market price of the share, market price per share is 100 rupees, which means total market capitalization of A Limited is 1 lakh. Same way, B has 2,000 shares listed and market value of each share, market price of each share is 120 rupees, which means the market capitalization of B Limited is 2,40,000, which means today market capitalization of A Limited plus B Limited is total 3,40,000. Are you all understanding with this? To put it simply, Nifty 50 stocks are there. I calculate total market capitalization of each and every stock, 50 stocks total. Okay, that will be my total market capitalization as of today. Agreed? Now what happens? Day 2, index will change. Yes, index will also change. Index points, day, not even day, every day it keeps on fluctuation, jumping up and down, up and down. How this happens? Okay, see, very simple. Day 2, what happens? A Limited outstanding shares, B Limited outstanding shares will be same. That is not an issue. But share price will keep jump up and down. It will keep on fluctuating. So, based on the second day share price, what is the second day share price? 110 of A Limited and 125 of B Limited, which means what is the market capitalization on the second day you need to consider. Up A Limited's market capitalization 1000 into 110, 1,10,000, and B Limited's market capitalization on the second day will become 2,50,000. The total market capitalization will become 3,60,000. Now you see, index was 100 rupees into index of the second year and day 1, which day 2, what is that? 3,60,000 divided by day 1 index. What is that? 3,40,000. Are you all understanding? So if you notice, see this. Index of the day is nothing but market capitalization of the day into index of the previous day. See, you can like this. Index, I have put it like this. No issue. Index of the previous day. Previous day index into M cap of this day, M cap of the day divided by M cap of previous day, you will get the 100 into, just now I told you 100 is a basic index point into 3,60,000 divided by 3,40,000. How much is that? 36 by 100 into 36 by 34, 105.88, which means this index will capture the appreciation in the share price of all these 50 companies. Are you understanding? Through market capitalization. This is just one of the method. Most of the indices in many of the countries follow this method. Some, also uses some other method. Anyway, this is very common. This you need to understand. In our country, thought is NSE consists of top 50 stocks. How this is being and one more thing is that, so return of the market. This is why I have explained this. Now you need to find out return of the market. Return of the market. Just now I told you index from 100 it jumped to 105.88. Correct. This is capital appreciation, share price, it is captured through share price appreciation. But apart from that, there is one important thing which you need to understand is the dividend yield. Okay, the stock, the BSE, NSE, the stock exchanges will publish, okay, average yield, okay, during this period of this index also, which means we have Nifty. Nifty, what is the average yield? In dividend yield will also be published. This dividend yield also you need to consider, because return comes from two sources, yeah, capital gain and the dividend portion, which means, so return of the market is nothing but year 1 index, okay, P1 minus P0 divided by plus D divided by P0 is there, na? Same way here also, year 1 index minus year 0 index divided by year 0 index. Apart from that, okay, plus dividend yield. This is, see, if dividend yield is given, yes, see, individually dividend is given, now you will consider in the initial introduction phase I told you, okay, year 1 P1 minus P0 plus dividend, I told you, correct? This is in amount terms, you will consider in numerator. Generally, indices, what will happen, the yield will be published, 3%, 4%, which is yield will be computed on market price. Already it is computed on market price. So what you do, simply you add up yield here, simply dividend yield, I can write it as dy, dividend yield. Are you all understanding? Which means year 1 index minus year 0 index divided by year beginning index plus dividend yield. Okay, this I have given. This is very, very important. This is how you compute RM, return of the market. Okay, return of the market. Okay, everything I have given. Now, important discussion, how to find out, same two things, how to find out portfolio return, how to find out portfolio risk. Now, portfolio return, now you have portfolio, you are constructing a portfolio which is consists of market and risk-free asset, because individual securities vanishes. Till now we considered A, B, C and all. Now everything get replaced by market. If when I say return of the market, which is return of the Nifty, which will include all the return of the individual securities. I already told you, na. Okay, indices, while computing the indices by market capitalization, it will already include the share price in it. It will already factor in the share increase or appreciation or depreciation. Capital gains, also yield will be computed, yield will also be added. So when I say return of the market, which is inclusive of all the return computed for the individual security, I forget about individual securities from here on. I only care about market. Are you all understanding? Now, I create a portfolio which is consists of market security, which is index plus Nifty plus RF. This is separate. Okay, capital market line, I include RF plus market. Now I need to find out this portfolio is there, na? This new portfolio which consists of market and risk-free security. Okay, I need to find out portfolio return and portfolio risk. How to find out portfolio return? Portfolio return, nothing will change. Weighted average return of the individual securities inside the portfolio. Upon risk-free security, WRF, weight of RF, into RF, risk-free rate of return, which will give you WRF plus into RF plus, okay, WM. What is WM? Weight of market into RM. RM is return of market. Upon weighted average return of the portfolio is nothing but weight of RF into RF plus weight of market into market, weight return of market. Are you all understanding? WRF into RF plus WM into RM. This is return of the portfolio which is consisting market and risk-free asset, index as well as risk-free asset. Now portfolio risk, what is portfolio risk? Again, here also you need to understand. Okay, see, portfolio risk is also nothing but weight of market into sigma m. Why? Same thing. Okay, correlation between market and risk-free asset, it will be 0, and anyway risk-free asset standard deviation will be 0, so the A square also vanishes, 2AB term also vanishes, only B will remain, which means what is that? Square root of B square, which is nothing but B, WM into sigma m. Okay, just like in the previous discussion, capital allocation, WS into sigma S we discussed, na. This is nothing but weight of S security into sigma of security. This also vanishes, market comes into picture, so weight of M into sigma M, just replica of all these things. There's nothing to discuss. Now, again, same way, portfolio, if you want to construct a portfolio which is having pre-assigned risk is given in the question. Okay, target risk of the portfolio is given. Okay, the 25% we consider now. How to find out weight of the, then how much of the market money you have to invest? Very simple. Weight of market is nothing but portfolio risk, sigma P divided by sigma M. This will again give you, okay, how much of my money should be invested in market. Weight of market will be given. Okay, now very, very important, capital allocation, capital market line equation we need to learn now. This is nothing but, okay, see, RF plus sigma P by sigma M, RM minus RF. Sir, what is this all about? I'll tell you. See, very simple. Okay, the line, everything is same in this diagram if you see. Okay, see. If I invest 100% in risk-free securities, just interpretation is very important. 2 minutes, you just focus. When I invest 100% of my security, my entire money I invest in RF, this point will be there. All my money will be blocked in risk-free security. The return I will earn is exactly RF, the risk-free rate of return. As and when I keep on injecting my market security, the market into my index into the portfolio, what happens? The return keeps on increasing. And at this point, the point of tangency at this point, okay, is a point where my 100% of money is invested into market. Very simple, yeah. If I invest 100% of my money into market, I will earn return of the market, RM. Assume Sensex gave me this year 20% return. Okay, if I invest 100% of my money into Sensex, I would have earned a 20% return from the market. Correct? Agreed? Now, the risk-free asset is 7%. Correct? This year, the RBI bond gave me 7% return. If I invest 100% of my return, okay, this bond will earn me 7% return. Correct? But if you invest in between these two, if your portfolio is having some portion of this much, some portion of risk-free asset, some portion as market asset. Now what we will do? What return it will yield? It will yield this 7%. Absolutely yes, because some portion of it will earn 7% return. But apart from that, okay, the RM minus RF is there. This is nothing. RM minus RF is called as market risk premium. To put it simply, if you take zero risk, you will earn RF. RF anyway you will earn by taking zero risk. Are you all understanding? Okay, but if you invest in your money in RM, due to that, okay, what will be your risk? Very simple. What will be your risk? Okay, your risk will be weight of the market into, okay, risk of the market. This will be, okay, sigma m, WM into sigma m, this will be the amount. Assume 50% is invested in your market and market risk is 20%. But 20 into, what is that, 50%. 10% is the extra, okay, risk you are taking, the premium which you are getting for taking the extra risk. Are you understanding? The RM minus RF, I call it as the premium which you are earning by taking additional risk. So are you listening what I'm trying to say? So simply the formula I just can show you. Okay, I don't want to get deep into that because see, we are doing revision. If everything is discussed, then what is the point? Okay, we have no time also. See, what is that? RF you will earn. Assume RF is 7%. Say RF you will earn, right? RF you will earn by taking zero risk. Plus, apart from that, you will also earn RM minus RF. This is the premium for taking risk. But this premium you will only earn for that portion of the amount invested in market. What is the proportion of amount invested in market? Weight of M. Agreed? This weight of M is nothing but, okay, sigma P by sigma M. This you will replace. Sigma P by sigma M is nothing but weight of the market. You will earn you will require the premium only for the amount invested in market portfolios, not for RF. Correct? That is how. Okay, capital market line. Tell me, children, what is the formula now? Capital market line. What is the formula? RF plus sigma P by sigma M into RM minus RF. Are you all understanding? This is the formula. The sigma P by sigma M only later in the capital asset pricing model it will turn to beta. Okay, and how it is different, what is the difference between CML, capital market line, and SML, I will elaborate there. Are you all listening? So this is the equation. This is called as capital market line equation. RF plus sigma P by sigma M into RM minus RF. This can also be simplified as like this: RF plus weight of M into RM minus RF. Are you listening? How the sigma P by sigma M came? This is nothing but weight of M. Okay, weight of M. That portion of the amount which is invested in market, that only will be demanding the premium. RM minus RF is nothing but premium over the risk-free rate of return. Are you listening? That premium only can be given for the amount invested in market portfolio and not the amount invested in risk-free asset, because the amount invested in risk-free asset will earn you full RF. Yeah, that is why RF plus beta and WM into RM minus RF. This WM, how this become portfolio sigma P by sigma M? I have explained here. WM is sigma P by sigma M. In capital allocation line also I have explained this. Okay, there. Okay, WS is equal to sigma P by sigma S. The sigma S and WS get replaced with sigma M because security will be replaced by market in this. And are you listening? This is the concept. Okay, here also one more thing. The extension also is borrowed amount. Okay, this is levered data. The market leveraged. So this is capital market line extended where you can also borrow and invest in market portfolio. Or are you listening? So this is also same capital allocation line. Everything is same. Shall we move on to the next concept? Yes, capital market. This question we already discussed. Yes, this question already we discussed in capital allocation line. And anyway, capital market line also 1 or 2 questions given in the study module, which we will discuss separately. No issues. Okay. Now we will move on to CAPM. Okay. Okay, CAPM we will try to discuss in the next video. With this, we are closing this session. In the next video, we will start the CAPM discussion and CAPM beta various formulas we will discuss. Thereafter, we will discuss proxy beta, portfolio beta, levered and unlevered beta. Everything will be covered in the next segment. Okay, thank you.